Right, what we are doing here is pretty straightforward today, considering that we have the notes. I think I carefully compiled these notes to be as much detail as possible, right? To answer all the questions that we might have regarding the foreign exchange markets and the exchange rates. So this is basically a 20-minute discussion or so. But I'm just hoping that in your spare time, you will be able to also go through the notes and make sense of what's being written here, or of what we are discussing today. All right, so what is the foreign exchange market? So previously we're looking at the balance of payments. So this is a continuation to the balance of payments. So here, everything affects everything, like everything else in economics. So all these topics are basically linked, right? So it's a build up from our balance of payments. I think the last thing that we dealt with on the balance of payments was something related to the imbalances, something related to the imbalances. So we did say that the balance of payments always balances, but doesn't mean that there are no problems associated with the balance of payments. So we refer to those as imbalances in our balance of payments, right? So picking it up from there, because there's the issue of trading, right? I think we basically discussed the the current account and the financial account. Those are the two main divisions there. Though the balance of payment is made of other things, other things are included there. But the main ones are going to be what deals with trade in terms of goods and services, and then the financial markets. And this is what we are doing here. So because of trade, because we are dealing with open economies, there's going to be the issue of foreign exchange markets. I think we did say that if you're going to trade with other countries or engage in economic activities with other countries, then there's a necessity that you exchange your currency to foreign currency, right, for you to be able to transact with other countries. So this is what we are picking it up from, right? So we are dealing basically with foreign exchange markets and the exchange rates. That's what we are doing today. So something that's obviously going to be relevant to our module, right? So we're not going to go into stuff that is irrelevant. All right, so the foreign exchange market is a market in which individuals, firms, banks buy and sell foreign currencies or foreign exchange, right? So that's the market. It's not exactly a physical market, as you know. It is not exactly a physical market, but it's a perceived place, basically, where individuals, firms, entities buy and sell foreign currency. Right? What are the functions of the foreign exchange market? Foreign exchange serves several crucial functions within the global financial system, and below are some of the functions here. Currency conversions, of course, if you'd like to transact in another country, necessarily you might have to change, or you will have to change or convert your currency into another currency. So be it traveling or investments, whatever the case is, all that is facilitated in that foreign currency market. So that's usually done through the banks. But usually do that through your bank, right? And then when that happens, it obviously facilitates international trade, and then it also determines the exchange rate. So the exchange rate is basically the prices. So like any market where there's equilibrium, that's where the price is ideally. Where your demand and the supply meets, that's where you basically get the price, right? So all that there happens in the foreign exchange. And then again, hedging, there's quite a lot of hedging that occurs there. I think we'll talk about hedging again much later. If you peruse through the notes, you'll see there is a sub-hedging there on hedging. But businesses and investors often use the forex market to manage risk by hedging potential currency fluctuations, right? And then speculations again. So when you talk of speculators, most of those are the ones that are going to be coming to you in your inboxes on social media. Those are speculators, most of them. They are speculators, foreign currency traders. They basically want to capitalize on the price fluctuations there in the market. So all that occurs in the foreign exchange market. So people can profit from that. Right? And then arbitrage, again, that happens. So arbitrage is pretty similar to speculation, right? But again, we will look into that much later. The forex market allows arbitrage opportunities where traders exploit price discrepancies between different currency pairs on different markets to make free profits, right? And then, of course, it helps again to provide liquidity. The forex market is one of the most liquid markets in the world. I think you should want to find out how big the foreign market is. You can just look it up and find out how many trillions of dollars are traded per day on the foreign market. So there's basically a lot of liquidity there taking place because of that high volume of transactions. And then central bank interventions, again, all those occur in the forex market, right, to try and influence the currency prices. Right? You do that in the foreign currency market. And then supporting investments and capital flows. So foreign investors often engage in the forex market to facilitate investment in other countries. So this is similar to facilitating international trade, except that now you are dealing in the financial markets, right? And then, of course, it helps in the global monetary system stability and information dissemination. So you can get information from the foreign currency market, right? Then what is a vehicle currency? What is a vehicle currency? And at this stage, we are hoping that our BRICS currency is going to be a vehicle currency, but currently the United States dollar is the vehicle currency. But what is it anyway? It's the reserve currency, it's the anchor currency. So it refers to a widely accepted currency that is used as a reference point in international trade. So if you're going to be doing international trade, you'll realize that most of the prices are going to be quoted in the US dollar. Right? So it's because it's the reserve currency of the world. So, like I said, we are hoping that that's going to change now that we want to bring in a BRICS currency. So we expect it to be a shift. But it will be interesting for you to find out how the United States currency ended up becoming a reserve currency, right? How it ended up becoming a reserve currency. But just to give you a clue, it's because it's the petrodollar, right? Basically, countries that trade in oil quote that oil in United States dollars. So hence the United States dollar has become useful. So still in that line, maybe what would happen if countries decide to ditch the US dollar? What would be the effect of that in the what effect would that have on the United States market in terms of its financial stability? What would be the effect on that? So that would be interesting to find out. So the primary functions of this US dollar in particular for now, which is our vehicle currency, is facilitating international trade, again in foreign reserves. So when we talk of foreign reserves, then we expect that it's going to be in US dollars. Right? So I think last week we were talking about some of these countries having huge reserves of foreign currency. So that foreign currency is mostly dominated in US dollars, right? And then of course, borrowing and lending. Do you know how much money we owe IMF? Whatever it is, trillions of US dollars. So we need to pay back that money in US dollars. Right? So unlike other countries, the United States can simply print out their currency and pay back their debt. So which means they don't exactly have to pay back their debt to the IMF. Right? It's the only country. Right, and then of course investments. Investors and funders and funds around the world assets dominated in the fiat currency due to its stability and liquidity. What keeps the United States dollar stable? That will be interesting to find out, right? Why is it so stable while other currencies fluctuate so much? And then, of course, the global monetary system. The fiat currency plays a key role in the international monetary system, so influencing exchange rates and helping stabilizing the global economy. So that's what it's ideally supposed to do. Right? But of course, we've seen them destabilizing currencies. Like we've seen them destabilizing currencies. I think we had a similar case here. I can't remember the year, but it's really not more than 10 years ago. The Absa scandal, right, where they were deliberately depreciating the rand. I think it was the time when the rand went up to 16 or 18 or so. So it was a deliberate move. So that's possible, of course, making use of the vehicle currency, right? You simply sell off or trade against the rand. The rand is definitely gonna fall under those circumstances. All right. So now that we have a market which determines the foreign exchange rates, now we're gonna see how that happens. So here you have the supply curve, and then there you have the demand curve. So one thing that you need to realize here on this curve, for the most part, right, if you look, for instance, at point E, the point E represents the equilibrium. So this is the point where, this is basically the point where the demand curve and the supply curve coincide, right? So what happens now, let's say, where the exchange rate is on 1.5, let's just say for some reason it's at 1.5 there. It basically, so this is a forex market, so we are basically trading foreign currency, right? So treat it like a commodity. Yeah, more like trading a commodity, and this is what we normally have anyway. So let's say this is what you have there, right? And then what would happen now if the price of foreign currency is at 1.5? So which means there's obviously going to be excess supply of foreign currency, and then the demand is going to drop there, right? And then likewise, if the price goes down to 0.5, right, the price of foreign currency, then there's going to be an excess demand, and then likewise there's going to be a reduced supply. So what I want you to realize now is these graphs that we deal with here, as you are moving up there, basically represents a depreciation in the local currency, and then when you are going down like that, it's an appreciation in the local currency there, right? Why is that the case? So if the price is going up here, we are basically saying the price of foreign currency is going up. So when the price of foreign currency is going up, it must mean that the price of the local currency is depreciating, right? So these basically don't move in the same direction. When one goes up, the other must go down, so the other goes down, because we are comparing them against each other, so they both can't rise at the same time. Right? So that's one thing that you need to be aware of henceforth when you are interpreting these graphs. But more of that much later. Then foreign currency depreciations and appreciations. So a depreciation occurs when the value of foreign currency decreases relative to another foreign currency. So it's always relative. We pair these two together. So it's falling compared to the other currency. And below are some of the reasons why that could be the case. Supply and demand imbalances, right? So remember, I think when you're doing your second year, you notice that when you deal with the foreign currencies here, the foreign exchange market, the demand is called a derived demand, right? It's called a derived demand. It's because in most cases you are demanding a certain product from another country, then that forces you to demand foreign currency, right? To demand the US dollar so you can buy that product. So whenever there is supply and demand imbalances, then that's gonna cause the currency to depreciate or appreciate, right? That works both ways. So which means, for instance, here, if, for example, there's going to be excess supply, right? If there's going to be excess supply there as a result of that, you're obviously going to see the results there or there, you see. So that's one thing that you need to be aware of. And then, of course, interest rate differentials. I think we spoke about how the interest rates on the last session, how the interest rates have an effect on the exchange rate market, right? And we even explained the issue of capital flows, right? And then economic weaknesses, right? All that is related, trade deficits, political uncertainty. So in most cases in African countries, once you see changes in the exchange rate, there's most likely political uncertainty there or economic weaknesses. So it's either of those there. Right. Okay, sorry about that. Let me just take this call.